Hello, I'm Derek McGinty, and on behalf of AARP, I want to welcome you and thank you for joining us. Today, we're going to discuss how taxes can affect your Social Security benefits. But before we begin, if you would like to listen to this town hall in Spanish, press *0 on your telephone keypad right now.
Si usted desea escuchar en español, presione *0 en su teléfono ahora.
Thank you for joining us today and participating in this nationwide teletown hall to discuss how taxes can affect your Social Security benefits. This is your opportunity to learn and ask questions. We are connecting with thousands of AARP members from all across the nation, and we'll be joined shortly by an expert from AARP and a retired expert from the Social Security Administration. AARP is a nonprofit, nonpartisan member organization, and AARP is in your corner, fighting on issues that matter to you and to your family. If you've participated in one of our teletown halls before, you already know this is similar to a radio talk show where you have the opportunity to ask your questions and get answers from our experts on Social Security. For those of you joining us via the telephone, if you would like to ask a Social Security-related question, press *3 on your phone to connect with an AARP staffer who will note your name and question and put you in the queue to ask that question live. If you're joining us on Facebook, you can post your question in the comments. Well, hello there. If you're just joining us, I'm Derek McGinty, and on behalf of AARP, I want to welcome you to this important Social Security discussion, how taxes affect your Social Security benefits. Thanks for joining us today and participating in this teletown hall to discuss what you need to know about Social Security. I would also like to remind you that we will be taking your questions live. So, to ask a question at any time, just press *3. And if you're joining us on Facebook, you can post your question in the comments. This session is intended to be informational and educational, so please consult your financial advisor for any specific guidance according to your individual situation. We will be sharing resources and phone numbers with you today, so you may want to grab a pen and paper just to have it handy. All right, let's get started. We've got a lot of information to get to today. You may be wondering exactly when Social Security benefits are taxed and why, and of course the big question is, how much? Well, you're in the right place because we're going to cover all of that and a lot more. With us today are a seasoned team of Social Security and savings and planning experts, and they will provide you with the answers you need to the essential questions you have about taxation and Social Security. We are joined by Stephen Richardson, retired Regional Communications Director for the Social Security Administration in New England. Stephen was hired by the SSA while still in college, and he was with them much of his adult life. He enjoys working with other service-minded people and breaking down the many rules of Social Security with an honest, straightforward approach. Stephen, thanks so much for being here.
My pleasure.
I'd also like to extend a warm welcome to Jamie Lyell. He is the Social Security Program Manager for AARP. And while he is new to AARP, he comes from the Social Security Administration with 7 years of experience focused on developing and examining Social Security claims. And Jamie, we are so glad to have you.
Happy to be here.
We'll also be joined a bit later in the program by Julio Rios with AARP Program Design, who will help to facilitate your calls today. Now, as a reminder to our listeners, throughout today's teletown hall, we are going to share your live questions with Jamie and Stephen. So to ask your question, please press *3. And if you're joining us on Facebook, once again, you can post your question in the comments. All righty then, Jamie, you shared a question with us that you get all the time. So why don't we start there? Why do people pay Social Security taxes in retirement when they already paid taxes while they were working?
Thanks, Derek. I think this is a question a lot of our listeners are thinking too. Simply put, taxes ensure Social Security continues to have enough money over time to be sustainable for all participants. Today's workers help pay for current retirees and beneficiaries' benefits, and any unused money goes to the Social Security trust funds to help secure future funding for everyone. Additionally, all the money paid in goes into one big pot. That means the money you pay in taxes is not held in a personal account for you to use when you're ready to claim Social Security benefits. It's more like an insurance. So it's not a one-to-one system where you pay a certain amount through a payroll taxes and then receive that same amount when you start collecting benefits. And that's the good news, because many beneficiaries actually receive far more in benefits than they personally contributed through their payroll taxes. And finally, when thinking about the why, it's also important to understand how Social Security is funded. Your monthly Social Security benefit is funded from three sources: the employee's payroll tax, the employer's matching payroll tax, and interest earned by the Social Security Trust. So you can see how everything fits together to make a strong, sustainable program.
I can indeed see how that works out, and it certainly helps put things in perspective, because it does sound like a lot of us will get more out of Social Security than we put into it, even after we pay taxes on some of those benefits. Stephen, anything else we ought to know about how Social Security is funded?
Yeah, Derek, it's important to remember that Social Security is funded through the payroll tax, which is withheld from most of your paychecks. This is called FICA, and it stands for the Federal Insurance Contributions Act. You pay about 6.2% in FICA tax, and your employer matches that 6.2%. So the total amount contributed to your Social Security is based on your employment is 12.4%. Now, it's a little different if you're self-employed. Self-employed people pay into Social Security through a tax called SECA, which stands for Self-Employment Contributions Act. It's collected through their annual federal tax returns. And since they are their own employer, they'll need to pay both the employer and the employee shares. Keep in mind that Social Security also earns interest on the trust funds, and this helps sustain the program. So there's even more money added into the Social Security beyond your contributions, which is another reason you will probably receive more than you put in.
Fascinating stuff there, and I appreciate it. And that explains the taxes that fund our Social Security. But what about the taxes on your Social Security benefits once you start getting them? Jamie, what can you tell us about that?
Well, Social Security taxes are based on the amount you earn. So if most of your retirement income comes from the Social Security, you most likely won't have to pay any federal taxes on your Social Security benefits because your income amount won't exceed the taxable threshold. We'll talk about those limits shortly. In fact, about 45% of retirees don't have to pay any taxes on their Social Security benefits. And the other, roughly 55%, only pay taxes on a portion of their Social Security benefits, not their entire benefit. I say portion because there's a limit. Only up to 85% of Social Security benefits can be federally taxed.
All right, Jamie, that is such a big range, right? It's a little confusing, 0 to 85%. Can you help us figure out what percentage of our Social Security benefits are taxable so we can get a better idea of the actual numbers involved?
Definitely. In short, remember the amount you're taxed on the Social Security benefits you receive is based on how much money you make or your income. More specifically, the Social Security Administration uses what they call combined income to calculate your taxable yearly income. Combined income is calculated by adding together half of your Social Security benefit plus your modified adjusted gross income, or MAGI for short. Since most of us aren't accountants and don't have a PhD in finance, let's break down what the MAGI is. MAGI is a combination of earnings from a job, withdrawals from tax-deferred accounts like a traditional 401k or IRA, as well as dividends, interest and capital gains from investments in any tax-exempt interest income. Tax-exempt interest income is exactly what it sounds like. Income from interest that you don't pay taxes on. One example might be the income you get from buying a bond in a city where you live like a municipal bond. I know that's not the easiest to understand, but the bottom line is simple. Social Security taxes are determined by two factors: your filing status, whether you file as a single person or a married couple, and your combined income. You'll notice I didn't mention your age. age is an important factor in deciding when to claim your benefit, but it does not affect your Social Security taxes.
That last part is very interesting. Thank you so much for that, Jamie. A lot of information, but I think I stayed with you on it. Before we return to talking more about income limits, though, which Jamie promised we would get to, I want to remind our listeners that in just a few minutes, Stephen and Jamie will be taking your questions live. So to ask your question, just press *3. And if you're joining us on Facebook, you can post your question in the comments. So, Stephen, let's get back to those income limits. What can you tell us about how your income impacts the federal taxes you pay on your Social Security benefits?
Well, as Jamie shared, Social Security taxes are determined by two factors: your filing status, whether you file as a single person or as a married couple, and your combined income. So before I dive into the specifics, I want to point out that the IRS has a helpful online tool called the IRS Interactive Tax Assistant. It helps you calculate how much of your Social Security benefit is taxable. Last time I checked, it only went up to the year 2022, but it should still give you a good sense of what to expect. The web address is really long, so I'd advise you to Google or search in your web browser the words IRS Interactive Tax Assistant. Again, that's IRS Interactive Tax Assistant. Now, with that, let me answer your question. I'll start with the married couples who file jointly. If your joint combined income is between $32,000 and $44,000, up to 50% of your benefits are taxable. If your joint combined income is $44,000 or more, up to 85% of your benefits are taxable. Now, if your joint combined income falls below $32,000, you won't pay any federal taxes in your Social Security at all. And for singles, or those who file as a single person, if your combined income is between $25,000 and $34,000, up to 50% of your benefits are taxable by the federal government. If your combined income is higher than $34,000, up to 85% of your Social Security benefits are taxable. Again, if you're single and your combined income is below $25,000, you're filing that single return, then you will not be taxing your benefits at all. Now, I know that that's a lot of information, so consider using the online tool called the IRS Interactive Tax Assistant.
Yeah, thank you so much, Stephen. We're really glad you're here. You know your stuff and you have a lot of details, but that IRS Interactive Tax Assistant definitely might be necessary to help us all keep pace with it. I'm sure this discussion has prompted questions, so let's get to our phones. Please press *3 on your telephone keypad to ask your question. And if you are joining us on Facebook, once again, you can post your question in the comments. Now I'd like to bring in Julio Rios to help facilitate your call. Hi, Julio, how are you?
I'm fine, Derek. Thank you for having me.
All right, so who do we have up first?
Our next caller is Jane calling from California.
Jane in California, you are live with us. Go ahead with your question.
Yes, actually it's similar to what you just mentioned, but do you have to go online to figure out how much of your Social Security is taxed versus your income?
Stephen, you got any thoughts on that?
Well, again, I think we went over the details of what constitutes combined income, right? That's the first thing you have to do. You have to establish what is combined income. And we went over that in detail regarding, half of your Social Security plus your modified adjusted gross income. So you got to really hit that. You really have to land on that actual number. And then in terms of what you think the tax may be, again, the IRS Interactive tool is a very, very good tool. And although the numbers don't go up, beyond 2022 as of today, that we're pretty certain of, it's still going to give you an idea of what that tax may be. And the tax rate differs, of course, depending upon what your Social Security benefit is going to be or what it is, and depending on your age. So there's a lot of other factors, when considering what that actual number is going to be and what that tax rate would be.
All right.
Again, just get your hands around what exactly constitutes combined income, and this will be very clear to you.
Thank you, Stephen. Appreciate the answer. Julio?
Yes, Derek. Our next question comes from Facebook, and the question is, are defined benefits pensions paid federally taxed if combined with Social Security?
So are combined benefits and pensions, do they account in terms of the amount of money you're taking in so that you can figure out what your tax is? Who wants to handle that one?
I'll take that. This is Jamie here. So yes, defined benefit pensions are generally federally taxed when combined with Social Security benefits. However, the amount of tax you pay on your pension and Social Security benefits depends on your total income and tax bracket. If your combined income exceeds a certain threshold, you may have to pay taxes up to about 85% of your Social Security benefits.
So does it matter whether or not you are working to get part of that combined income, or is it just a pension? Does that make any difference?
And I'll pass that to Steve.
Steve, what do you think?
Not really. It really doesn't make that much of a difference.
All right, fair enough. Julio.
Yep. Our next question comes from Patricia calling from Michigan.
Patricia in Michigan, thanks for joining us. What's your question?
Okay. I am 87 years old, and I just received my Social Security and my pension, which totals about $30,000. I was just looking to see how much I get for Social Security. It's $2,500, and my pension and then my pension is $210. And do I still have to keep paying Social Security when I buy in a year or two?
As far as taxing your Social Security income, you're really close to the thresholds. And what Jamie and I would always say, in a case like this, is we really don't know much about the details of your entire retirement portfolio. We really don't know everything. You've given us enough information that says, look, you're really on the cusp of having to file taxes or not filing taxes. Consulting a tax expert might be the best way to go with this particular question. Somebody that is more familiar with your entire retirement income and your entire portfolio, because there could be some things that we didn't miss or didn't bring up here that we'd be giving you the wrong information. It's always best to consult with a tax expert on that question.
I think that's a great answer, Stephen. Thank you so much. Julio, who's next?
Yep. Our next question comes from Debbie from Facebook, and Debbie asks, is your Social Security benefit included in the combined income?
Gentlemen?
And I'll answer that.
Go ahead, Jamie.
I'll take that one. According to Social Security, the combined income is defined as the sum of your adjusted gross income, non-taxable interest, and half of your Social Security benefits. If you have any substantial income in addition to your Social Security benefits, such as wages or your self-employment, dividends, or any other taxable income, that must be reported on your tax return. You may have to pay federal taxes on your Social Security benefit, again, up to only about 85%.
All right. Thank you so much. Julio, anybody else?
Yep. Our next caller is Jacqueline calling from Michigan.
Jacqueline in Michigan, thanks for joining us.
Hi.
Go ahead with your question, please.
My question was, I've forgotten how I was there.
You get your late husband's Social Security?
Yeah, I do. I get his. I get his Social Security, and I get taxes are still being taken out. Should taxes be taken out, and should it be a lower amount than what the normal person who works? That amount. I don't know what it is. I don't even know what that.
Yeah.
I don't know what the amount is right now.
Well, if you're filing an individual return, remember it's $25,000 to $34,000. 50% of it could be taxable. Over $34,000, 85% could be taxable on an individual tax return. So it's important that, going back to earlier in the presentation, we talked about what constitutes the trust funds. What is it all about, and who does it pay? And it just doesn't pay retirees, Jacqueline. It pays spouses benefits and survivor benefits and divorced spouses and divorce surviving benefit and spouses, as well as Social Security disability insurance beneficiaries. So they're all included in this tax thing. And depending upon what your combined income is when you're filing your taxes, that's going to dictate if you have to pay taxes on those benefits or not, I'm afraid.
Stephen, it's an interesting question because what she seems to be getting at is there a difference in terms of the federal government and how they calculate your income between a survivor benefit and just regular Social Security?
No, it's whatever your combined income is.
Right.
Whatever, right? What's combined income? Half of your Social Security plus your modified adjusted gross income.
All right. Julio.
Yes, our next caller is Mary from Pennsylvania.
Mary from Pennsylvania, you're on the air. Go ahead.
Well, my question concerns the threshold amounts of $25,000 and $32,000. These thresholds have been in place for approximately 30 years, and they have not changed with inflation. Is there any consideration to changing these so they move with inflation?
That is an excellent question. I love that question. Stephen, what do you think?
Yeah, that's the question of all questions. And in my 40 years of working with the agency, you are right on the money with that. They have not changed. Those thresholds remain at this number. I'll say this. There have been some changes in this particular law in the early 80s when taxation of Social Security first hit the books, when it was signed as part of the Social Security Reform Act. The numbers where it was a far more simpler formula. It actually got a little more complicated later on in the 90s that included all these other brackets. But yeah, at the end of the day, it has been a long time since those have been changed. And I guess my point there is since the taxation itself was on a Social Security Reform Act, that it's really Congress are the ones who decide if those benefits, if those thresholds get modified or to keep up with the times, if that's probably what you're asking. So the short answer to the question is you are right. Absolutely. They have not changed in a long time. But it would be a congressional act, generally a congressional act to make the change.
All right. Excellent question. Thank you. Great answer as well, Stephen. We appreciate it. Julio, do we have another caller?
Yes, we do. We have Eunice calling from Kansas.
Eunice in Kansas. Your question, please.
Yes. Hello?
Yep, we're waiting for you.
Oh, I'm sorry. Thanks for taking my call. I wanted to ask you, I have retired and I went back part-time at 80 years old. I didn't sign for them to take out anything out of my salary. Will I be charged for that?
I would imagine it would depend on what your salary is. What about that, Stephen or Jamie?
Yeah, sure. Go ahead, Jamie.
I was actually going to just pass it to you, Stephen, since you're always
sure. Yeah, I think wages in general. I would often be asked this question first: that if somebody goes back to work after they retire, do you still have to pay Social Security taxes on your wages? And I would always remember what Ben Franklin said, right? I mean, what are the two certainties in life? And taxes are one of them. Right. So you'll be paying taxes on wages no matter what the age. If you are working, you'll be paying taxes. You'll be paying the Medicare tax. You'll be paying the Social Security tax. And again, we make a good point about what are your wages? How much are you making? What would be the tax pull on it? And again, how would it affect the taxation of your Social Security income? It's difficult to know without knowing exactly, what your income is. Now it sounds like you're probably working on a part-time basis. I just can say with certainty that they're going to continue to take Social Security benefits out of you. And let me just close with this. Depending on these wages and how much you're making right now, it's a common question because a lot of people go to work after they retire. And the follow-up question is always, hey, do I see an increase in my Social Security benefit with these earnings? And the answer is it depends. It depends on how much you make, and it depends if it replaces one of your high 35 years of wages that you had earned earlier in life. So you may very well see an increase in your benefit with these wages. I hope that helps.
I hope it does too. Thank you, Stephen. Let's get one or two more.
Our next question comes from Frank, and he asks, say I begin benefits at my full retirement age and I continue to pay payroll taxes. Will my benefit increase up to age 70?
That sounds like it's a little bit related to what was just asked, Stephen.
Yeah, a couple of things going on here. All right, so this gentleman, he decided to draw his benefits, right? He decided to draw. And essentially what happens when you draw is you generally lock into the amount. Now, in terms of the earnings, I just answered that. If these earnings replace one of your high 35 years that Social Security already used to calculate your benefit, then you may see an increase in your benefit. But it's important to point out, and this is a great example and a good time to do it, that if one delays, like they have the option to do, if one delays collecting from their full retirement age up to age 70, Social Security pays what are called delayed, or grants what are called delayed retirement credits, where you can see your benefit increase as much as 8% a year up to age 70. But in this particular case, he drew benefits, right? He flipped the switch. So he's not going to get those delayed retirement credits because he didn't delay. But to close out, you may very well see an increase. It depends on how much your wages are.
All right. Thank you, Stephen. Some great answers to some fantastic questions from our audience. I want to thank Jamie and Stephen for answering those. We're going to get to more caller questions later on in the program. But, Jamie, right now, I'd like to discuss the impact of other sources of income on Social Security. How does rental income impact Social Security benefits and the taxes on those benefits?
That's a great question, Dirk. The Social Security Administration does not count rental income as earned income. So any rental earnings won't impact Social Security benefits. However, the IRS treats rental income as regular income for tax purposes. So you will be taxed on the rental income. Rental income does not count toward your combined income. So if your combined income puts you above the threshold, as Stephen mentioned earlier, then your Social Security benefits could be taxed. For example, if you were married and filing jointly and any rental income puts your combined income over $44,000, then up to 85% of your Social Security benefits would be taxable.
All right, so I want to get this straight because that's a little bit confusing. The Social Security Administration doesn't count your rental income as earned income, so in other words, it won't really impact your benefits. However, for tax purposes, you will be taxed on that rental income, and it does count toward your combined income, so that if it can push your threshold up, and therefore your Social Security benefits could be taxed. Do I have that about right?
About right, yes, Dirk. So you'll need to take required minimum distributions, or RMDs, starting at age 73. These withdrawals do go into your combined income, so yes, they can impact your Social Security taxes. If you want to get into the nitty-gritty of how RMDs will affect your specific financial situation, I'll definitely recommend talking to an accountant or a certified financial planner.
One more question for you, Jamie. How does the Social Security COLA, or cost of living adjustment, impact the taxes?
Okay. The Social Security cost of living adjustment, or COLA for short, is an annual increase in the amount of Social Security benefits that keeps pace with inflation. When inflation is running higher, COLA will be larger. For most people, COLA does not impact taxes. But you do need to be aware of it because there are some cases where COLA could push your income limit into a different tax threshold. Bottom line, if COLA increases your combined income above $25,000 if you're single, or $32,000 if you're married, it could significantly increase the taxes you pay. If you're wondering if COLA will impact your Social Security taxes, and if so, by how much, you can use the IRS calculator mentioned earlier. And if you're wondering what the current COLA is, you can easily track it at bls.gov.
Thanks, Jamie. I'm going to switch gears for just a bit here. We've been talking about federal taxes, but what about state taxes on Social Security benefits? Stephen, what can you tell us about states that may want a piece of the action?
Well, there are 11 states that will tax Social Security benefits in 2024 to varying degrees. So you have states like Colorado, Connecticut, Kansas, Minnesota, Montana, Nebraska, New Mexico, Rhode Island, Vermont, Utah, and West Virginia, while Missouri currently taxes Social Security benefits. Because of recently passed legislation, it won't be taxing any Social Security benefits beginning in 2024, and Nebraska will stop taxing benefits in 2025. Now, some states follow the federal rules for determining if benefits are taxable. Other states, they have their own sets of deductions and exemptions based on age and income. States like Colorado, New Mexico, and West Virginia are eliminating taxation of benefits for most older residents. For details on how benefits are taxed in your state, please contact your state Department of Revenue.
Thank you, Stephen. I just want to take a few minutes here to bring in our Government Affairs Director, Tom Nichols, to share how AARP is fighting for Social Security and the biggest issues that affect older Americans. Tom, good to chat with you.
Thanks, Derek. Likewise.
Now, we know that Social Security has always been and always will be one of AARP's top priorities. But what is AARP fighting for, and why is it so important?
So you're absolutely right. So the fight to protect Social Security is so important because this is your money. This is why AARP is urging Congress to protect and save Social Security for the long term and make sure Americans get what they've earned and paid into. You know, Social Security touches the lives of nearly every American, and our elected representatives must commit to making sure it is stable and adequate for the long term to make sure Americans get what they've earned and count on.
State governments also play a role in this as well. Should listeners make sure their local lawmakers are doing what they can to protect their earnings?
Absolutely. So AARP is fighting for laws around the country to reduce or eliminate state taxes on Social Security income, and we highly encourage folks to join us. We're grateful that we've won some major victories in Missouri, Vermont, Nebraska, and New Mexico, and we're really hopeful that more states are going to follow with folks' help.
Now, when it comes to customer service issues, the Social Security Administration has not been as great as we'd like. What is the AARP advocating for on this front?
Well, and that's right, unfortunately. So we are pressing Congress to increase funding for the Social Security Administration to help correct the serious customer service problems at the agency, which can significantly delay seniors and people with disabilities from getting the benefits and services they need. Funding for the Social Security Administration has been lagging for years, and AARP is calling on Congress to increase that funding to help improve these customer service problems. You know, as seniors and people with disabilities, they can't wait. They need to receive these vital services right away that they've earned and depend on.
Indeed, they do. Now, before we let you go, Tom, Medicare, another top priority for AARP. Historic prescription drug reforms recently were enacted into law. So what are some of the changes folks can expect?
Yeah, so after decades of calling on Congress to make prescription drugs more affordable, we are proud to report that AARP won the fight to let Medicare negotiate lower prices on some prescribed medications. The federal government just announced the first 10 prescription drugs that Medicare will start negotiating for, and these include life-saving blood thinners, diabetes, autoimmune, and cancer medications. The new law also caps the cost of Medicare-covered insulin at $35 a month and eliminates out-of-pocket costs for most recommended vaccines, such as the new COVID booster and shingles vaccine. These changes will make it easier for older Americans to stay healthy and will save taxpayers billions of dollars.
That's good news for us. Thank you, Tom. And if listeners want to stay on top of AARP's advocacy news, how can they find out a bit more?
Yeah, so we encourage everyone to go online to aarp.org/get involved, all one word, and sign up for the AARP Advocate. This is a free monthly e-newsletter, and you'll also receive email alerts and the latest advocacy news. aarp.org/get involved is an easy way to make a big difference.
That's terrific. And thank you, Tom, for joining us today. All right, let's get back to some caller questions. Please press *3 on your telephone keypad to ask your question. And if you're joining us via Facebook, you can post your question in the comments. Julio, what's the next person on the line?
Yep. The next person is actually coming from Facebook. So Paula asks, can we ask Social Security to take taxes out so when we get our monthly benefit check, the taxes are already deducted?
Ooh, that's a good question. Who wants that one?
I take that one. So yes, you can ask the Social Security Administration to withhold federal taxes from your monthly benefits. That way they'll automatically deduct it and you won't have to worry about paying them separately. You can do that by requesting what they call a voluntary withholding request, also known as a W-4V, as in Victor, form. You can get that from the IRS website, or you can actually call Social Security directly and request that.
All right. You're the man, Jamie. Thank you. Julio?
Yep. Our next caller is Lonnie from Arizona.
Lonnie from Arizona, your question.
You explained that there are 3 different tiers of taxation. And if you are making above that highest tier of joint of $44,000, does that mean your first tier of $32,000 will be taxed at 0, the second tier from 32 to 44 at 50, and the third anything above that at 85, or is it all at 85%?
That is another really good question. Stephen, what do you think?
Over that combined income, it's all at the 85%. That's how, whatever your combined income comes into landing. I think I know what you're asking. I mean, it's a little different way to look at it, but it's pretty set. If you're between the lower and the higher, 50% of your benefits are subject to tax. If you're over the higher, 85% of your benefits are subject to the tax.
And there you have it.
And again, I'd have to impress on people to go to the IRS Interactive Tax Assistant. It's excellent, and it'll tell you exactly what what your liability is.
And you're excellent too, Stephen. Thank you so much for that answer. Julio, go ahead.
Yes, our next caller is Jeanette from Colorado.
Jeanette from Colorado, what do you want to know? Jeanette, are you there?
Yes.
Hi, what question do you have?
Oh, I was just wondering, I've turned to 68, and, I look at the thing I get in the mail from Social Security, and, at 70, I get a lot more money, but then I pay a lot more taxes. So, should I collect now, or should I wait till 70? I don't need the money.
This is an interesting question.
This is really this is the question. Jeanette, this is the question of all questions. I mean, and just the fact that you've tuned into this call says you're well on your way to landing on the answer to this question, because what you do have to do is get your hands around all the rules and all the moving parts within this Social Security law, and there are many. So you can land on the all-important answer to the question of when. And everybody's when is different. There is no magic bullet. There is no, set answer. Social Security will tell you, hey, if you wait till age 70, they will pay you the maximum benefit they can pay you. You have taken advantage of the delayed retirement credit increase for every year beyond your full retirement age of about 8% per year, increasing your benefit up till age 70. You've done that. You've taken those steps to do that. And again, you make a very good point about I don't need the money. And this is where, you do want to speak with people. And it's important that people understand that this is truly part of your retirement portfolio, this Social Security thing. So you'll have to sit back and think, okay, I'll be taxed. What do I need? What are my needs in life? What do I need? Am I paying my bills, my everyday living expenses, things of that nature? Take all this into consideration when you want to land on that answer. We're sorry there is no set answer for you, but there's so many different variables to look at. But I'll tell you what, you're well on your way just by the fact that you tuned in today.
Thank you, Stephen. It feels like a lot of people are looking for these very, very direct answers to questions where the answers are a little bit more ambivalent sometimes, depending on a person's situation. Julio.
Our next question comes from Facebook, and Terry asks, can you address the W-4V and how to determine if you should check the 7, 10, 12, or 22% box when newly retired? We also have a state form in Vermont because Social Security is taxed here. We are about to fill out both forms to have taxes withheld instead of having to pay a lot when filing in April.
That is a very detailed question, and I don't know. Stephen, do you have any thoughts on that at all?
Well, again, I mean, this is where, speaking with a tax advisor or consulting with a tax expert, may be the best way for you. And again, because you would have to answer this question, the 7, the 10, the 12, or the 22, I mean, you'd really have your hands around what your entire retirement portfolio is looking like and what your assets look like. This is the options that the W-4, give that Jamie and I are familiar with the agency. They do give you some options regarding withholding, and that's a good thing. But again, landing on and how to land on and when to land on each one of these different variables is really a question that, you really need to look at the whole picture, your whole retirement picture, to really zero in on what the best avenue would be.
Julio, do we have another caller?
Yep, we have another question from Facebook, and then Brenda asks, what's the COLA for next year? When do we receive the increase?
Jamie, any thoughts?
Yes, so we're waiting actually for that to be announced. October 12th is the future date for when the COLA should be announced, everything going according to plan. and then you should see that increase in your next year check, monthly retirement check for Social Security.
So the fact that inflation has been higher the last couple of years, I take it that does impact the COLA increase, correct?
Yes, they'll use a calculation. The government has that calculation that they'll use to determine that COLA increase. Through the news, it's looking like it'll range somewhere between 3.2% on average, but we'll still have to wait till October 12th or around that date.
All right. Thanks, Jamie. Julio?
Yep. Our next caller is AJ calling from California.
AJ from California. Your question.
Hello. Sorry about the horrible static on my line. I just turned 70 this year. I delayed accepting Social Security because for a bunch of reasons. But I have not had any taxes withheld from my Social Security income. So I want to know if I'm going to be penalized for not having taxes withheld.
So
my estimated income for this year will be probably $50K.
All right. So you want to know that not just will you have to pay the tax, but will there be a penalty, correct?
I'm asking about the penalty.
Okay. Good question. Stephen?
So I'm a little confused. The penalty, a tax liability penalty or wages penalty? What are we referring to exactly?
Not having had taxes withheld penalty.
Okay.
You know,
so
if you don't pay enough taxes, sometimes they will charge you for that.
You can't really look at it as a penalty. I mean, if you didn't pay the taxes, you're going to have to pay the taxes at some point when you file your returns. And depending upon what your combined income is reflected on your tax returns, that will dictate the amount of taxes that you'll have to pay. The W-4 allows you to do it throughout the course of the year, so the sting isn't so bad, right?
I think she's asking, is there an underpayment penalty of some sort, for not having it withheld?
No, not that I'm aware of.
All right. Does that help you, Jack? Well, she's gone. All right. Julio, you're next caller.
Our next caller is William calling from Wisconsin.
William from Wisconsin, you're with us live.
Yes, the question I had is I'm 75 years old, and I basically am living off of my Social Security income. But the thing is, I have some stock holdings and stuff like that. But the stock holdings are just random. One month you might get paid a dividend or something like that of $150. Another month you might get $1,000 or whatever. But you were talking about that thing about a threshold being like $25,000. How does this all play in about the fact that I don't know what my income is going to be because it just is random as to what the dividends are paying out and stuff like that, and the rest of my money is just what I get in the basic Social Security amount, which is very, very low. I mean, it's not very much Social Security I get at all, and so I'm counting on the dividends to give me enough money to even live off of.
This is a very interesting question. Stephen?
Yeah, I mean, as Jamie pointed out, modified adjusted gross income, it's earnings from a job, withdrawals from tax-deferred accounts like a traditional 401k and an IRA, as well as dividends. So is it part of your modified adjusted gross income? Yes. So whatever it ends up being at the end of the year, I mean, that's the number. I mean, again, it would be wise perhaps to speak with a tax consultant or a tax expert just to maybe get a sense of what kind of income, or a financial planning expert to get a sense of what your yields might be throughout the year, just to give you an idea of what kind of income you might get off these dividends. But depending upon what those numbers are, that's if you fall within those categories, those combined income categories, your Social Security benefits will be taxable.
A lot of interesting questions today. Thank you, Stephen. Do we have a caller or two more?
Yep, we do have one more question from Rhonda from Facebook, and she asks, if you make an income over your taxable Social Security amount, do you then have to pay taxes on the total income, including your Social Security, or just what your income is over your taxable Social Security maximum?
No, that's an interesting question, too. Jamie, any thoughts there?
Yes, thoughts on that one, Derek. Thank you. If you make an income over your taxable Social Security amount, you will have to pay tax on a portion of your Social Security benefits. That amount, of Social Security benefits that are taxable depends on that combined income. Remember, that combined income is between $25,000 and $34,000. You may have to pay an income tax up to 50% of your Social Security benefits, and if your combined income is more than $34,000, it goes up to 85% of your Social Security benefits that will be taxable.
So it's not just the amount that you go over that limit. It goes back and gets money from their whole Social Security or from your entire income.
Yes.
All right. Do we have one more?
We're good to go.
We're good to go right now. All right, let's continue on with our conversation. We're talking about Social Security taxes, and it is there are some fantastic questions out there, as a matter of fact, and it's really given me an insight into some of the things people are worried about regarding their Social Security taxes. But Jamie, are there any strategies out there that could help people lower the amount of taxes that they have to pay on their Social Security benefits?
Yes, there are a few strategies that I'm happy to share, but you can and should talk to them about that with your tax professional. Remember, your Social Security taxes are based on your combined income, so the key to paying fewer taxes is lowering that number. You could attempt to do that by minimizing taxable traditional 401k or your IRA withdrawals, because these are taxed as ordinary income. If you withdraw over a certain amount, you may inadvertently put yourself in a higher tax bracket and owe more taxes. That said, you must be sure to withdraw enough to meet any required minimum distributions or RMDs you might have, so that's where you'll want to strategize. If you haven't claimed your Social Security yet, consider taking your IRA or 401k withdrawals before you claim. There are a couple of advantages to this approach. First, taking distributions from tax-deferred retirement accounts will reduce your balance in that account, which in turn reduces the size of your future RMDs, which are determined partly by how much is in the account. By extension, you will also reduce your future adjusted gross income and modified adjusted gross income. And second, generating income from your retirement account early might allow you to delay taking Social Security, which could result in a bigger benefit for the rest of your life and the lives of your spouses or dependents who might draw on your benefit.
Some very good tips there, Jamie. Thank you so much. Stephen, do you have any other tips for lowering taxes on your Social Security benefits?
Well, you could consider withdrawals from a brokerage account, where long-term capital gains are taxed at a lower capital gains tax rate, generally between 0 and 20% if you held the investments over a year. You could also make tax-deductible contributions to your retirement accounts. Contributions to an IRA can be fully or partially tax-deductible, which can lower your adjusted gross income or your modified adjusted gross income. Keep in mind, the IRS sets annual limits on deductible IRA contributions. So my best advice would be to consult with a tax advisor or a certified financial planner. If you don't already have someone you like to work with, you can find one at cfp.net, that's cfp.net, or ffp, probono.org, ffp. probono.org. FFP Pro Bono, it helps you connect with certified financial planning professionals across the country who provide free, no strings attached financial advice to underserved people in need. This pro bono financial planning, it helps people take control of their financial lives, and it has a positive impact on individuals, families, and communities. And it also elevates and enriches the financial planning profession.
Fantastic. Great tips from our experts, and I'm sure that those have prompted even more caller questions. So let's take a few more of them via our phones. And please press *3 on your telephone keypad right now to ask your question. And again, if you're joining us on Facebook, post your question in the comments. Julio.
Our next caller is Naomi from Georgia.
Naomi from Georgia, what's your question? Naomi, are you there?
I'm here, but I've already given my question and I've gotten an answer.
Okay, then thank you so much for calling. We appreciate you. Julio, who's our next caller?
Our next caller is Libby from Pennsylvania.
Libby from Pennsylvania, I hope you have a question.
I'm still here.
All right, go right ahead.
My question is, I'm a widow. I'm 87 years old, and I would like to know, I had income. I had Social Security of $1,759, and because I have royalties coming in from the Marcellus gas wells in Pennsylvania, they lowered my Social Security to $1,736.50. Now, if that royalty increases, which it could because each month it's different, will I continue to lose Social Security benefits?
Now, let me make sure we got that straight. Your benefit went down by roughly $30 a month?
Right.
Okay, and you're worried that if your income goes up, it may go down further?
Yes.
Oh, that's a tough one. Stephen, any thoughts?
Well, I mean, are you having taxes with taken out of your Social Security benefit right now? And that's where I pay
quarterly. I pay quarterly.
Yeah. Okay. Well, you might want to speak with a tax expert or a tax consultant. I'm not quite sure why they're deducting benefits from your account out of your payment if you do not have automatic tax withdrawal set up already. It could be an increase in your Medicare Part B premium. There could be a number of things going on here relative to what your income is, your overall income. But I would strongly recommend you speak with a tax expert, and so you can land on exactly where, what amount should be taken out so you don't have any sort of, penalties or anything incurred, a larger tax bill later in the year, if you will. So I would do that. Now, regarding your Social Security benefit, I mean, Jamie and I, we really can't zero in on why that benefit would be reduced. You can always call the agency's 800 number at 772-1213, and the representative will tell you exactly what your benefit amount is and what it's based on. And they'll also tell you what your Medicare Part B premium or Part D, as in drug premium, may be. So the answer may lie in there somewhere. I hope that helps.
I hope so, too. And what she seems to be asking is, does the amount of money she has coming in, let's say it goes way up, does that make her benefit go down? And you seem to be saying not necessarily.
Well, not unless you request tax deductions out of your check with the SSA 4. Yeah.
All right, thank you, Stephen. Julio?
Our next question is Teresa calling from Texas.
Teresa from Texas, we'd love to have your question.
Yes. If your income is less than $25,000, do you still have to file an income tax?
That's actually a very good question.
Yeah, so to answer your question, if the Social Security income that you're receiving is your only source of income, then you're not required to file a tax return since you're under that threshold for single filers, head household, or the qualifying surviving spouse.
All right, thank you, Jamie. Julio, who's our next person?
Our next question comes from Marilyn calling from New Jersey.
Marilyn from New Jersey, your question.
Hi, thanks for taking my call. My question is, I just started, I just filed for Social Security because I just turned 70, and I got 2 letters from them reminding me. But I'm still working full-time, so I will exceed the combined income for filing jointly. Can I make up the shortfall through my regular payroll deductions to cover the additional taxes I'm going to have to pay on the Social Security income, or does it have to come from a Social Security check?
I love these questions. They're so interesting. Stephen, do you have any thoughts on that?
Well, I think, again, I would speak with a tax consultant. I would consult with your accountant on that, how you could go about paying additional taxes. I mean, the W-4, it's just how much you want taken out of your Social Security check. That's the prediction you make. At what percentage do you want reduced from your check to cover the taxes? And this is where a tax consultant really comes into play, because they'll look at your entire portfolio and make sure they don't miss anything regarding what other income or dividends or anything you might have, just so you can sort of zero in on and lessen that tax hit during the tax season. I hope that helps.
Yeah, she seems to be kind of saying, is that money sort of interchangeable? In other words, if I take it from my paycheck, is it the same as taking it out of the Social Security? Can I balance them out in some way?
Well, I mean, no. Not. I mean, in the pure sense, no. If you're continuing to work, Social Security taxes will be taken out of your wages. and then you'll just have to decide what the best road you're going to take regarding what your combined income is.
I understand. Let's get another phone call. Julio?
Our next question actually comes from Facebook, and Travis asks, do the income thresholds for taxing Social Security benefits also apply to SSDI?
Oh.
Yeah, this is a really good question. And again, we talked earlier. Who are the beneficiaries that draw benefits from the Social Security trust funds? And Social Security disability insurance beneficiaries do. So yes, the answer is yes. People on Social Security disability insurance, their benefits may be taxable as well if you exceed these combined income thresholds.
Up next, Julio.
Another question we have from Randall, and he asks, how often does Social Security recalculate benefits based on your earnings?
Jamie, any thoughts?
Yes. So Social Security Administration recalculates your retirement benefit each year after getting your income information from your tax documents. If you have a job, employers submit a W-2 to Social Security, and if you're self-employed, your earnings data comes from your tax return. Definitely keep in mind for any future questions as far as with your taxes, keep in mind of the CFP.net and that FFPprobono.org that Stephen mentioned earlier.
All right, thank you, Jamie. Next caller, who is it?
Next caller is Beth from New Jersey.
Beth from New Jersey, welcome.
Yeah, hi. Thanks for taking my call. I'm currently getting a pension, and it's automatically tax deducted. So when I go to my tax preparer, I also have to pay tax for Social Security. However, I don't have that automatically deducted. I think, aren't I like double taxed or something? I'm getting taxed for my pension, federal, and then I'm getting taxed federal for my Social Security as well. I mean, do they consider the taxes that I pay for the pension? The Social Security considers the taxes that I pay for my pension. I don't understand. I feel like I'm double taxed here. I pay like $3,000 in pension, a tax, and then I owe $5,000 in Social Security tax. So that's like $8,000 withheld just for
all right.
20.
Let's see if our experts have any thoughts on that. Is she being double taxed, guys?
Well, as far as the pension goes, you'd have to go back to the entity who pays the pension. We don't know who it is, and again, what kind of income that pension gives you, and whatever the tax laws regarding income, federal and state taxes regarding that income. I guess the short answer, ma'am, is they're going to tax you on both of them because they're both income, and their income in retirement, and if they exceed certain thresholds, you're going to pay taxes. Again, we gave a lot of different ideas earlier about what you can do to sort of things you can do to your portfolio to perhaps lessen the tax, going forward. So working with a tax expert, or again, as Jamie mentioned, and we'll do it again, CFP.net or FFPprobono.org, they may help you, down this road. Again, it's difficult to answer that question straight out because we're not familiar with your entire retirement portfolio. We don't know what your other assets are or what other options you may have going forward. But the short answer is you're going to be taxed on both. You're definitely taxed on your Social Security income. You'll have to go to the pension entity who administers that tax to get a 100% straight up answer whether that is taxed or should be taxed.
I think we might have time for just one more.
Yep, our last caller is Joan from Minnesota.
Joan from Minnesota, thanks for joining us.
Hi. I recently, or within the last year, I applied for my late husband's Social Security, and I chose not to have federal tax withheld. I also receive a pension and do not have taxes withheld from that. So my questions are, will I be hit with a big tax bill next year, and will I have to pay the federal taxes back that weren't withheld? And since I live in Minnesota, I know federal or Social Security is also withheld. Taxes are withheld in Minnesota, and I have no idea how much the state withholds.
All right,
I'm kind of in the dark about all of this.
I understand. Let's get our experts in here. What do you think, guys?
I'll answer that one. So for the answer to your last question for your state of Minnesota, as of 2023, now married filing jointly would have been subject to 5,840. But head of household and single filers can subtract up to 4,560. A pension you receive directly from a railroad company does not qualify for the subtraction. Also, if you want to find out more about your state taxes and how they're being withheld from your Social Security benefits, best option will be to contact the agency directly at that 1-800-772-1213 phone number, or just visit your local SSA office.
All right, guys, thank you so much. And thanks to the listeners for asking all sorts of really fascinating and very intricate questions. We really appreciate you. And we appreciate Jamie and Stephen for sharing their great information and answering those tough questions from our listeners. We hope you all learned something new today. I know I did. Thank you, and have a great day.